If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? My name's Obi, and welcome back to the Courtside Financial Podcast, your go-to stop for all things business and technology. Today's episode, we're going to be talking about some major updates and insights that are surely going to affect the future of the electric vehicle market, meaning that they will have an impact on NIO as well. So it's going to be a super good, insightful episode. But if you're new to the channel, make sure you hit the like button, make sure you hit the subscribe button, click the notification bell icon, and leave a comment down below. Your engagement really does go a long way in helping out the channel, helping us to reach a broader audience. So without further ado, let's get into today's episode. Let's get into the first major topic of discussion, the potential for China to raise tariffs on large displacement fuel vehicles. Now, why does this matter to us as NIO investors and enthusiasts? Well, the Ministry of Commerce recently held a meeting to discuss raising tariffs on cars with larger engines than 2.5 liters. We're talking about a significant segment of vehicles mainly imported from Europe, Japan, and of course the United States. To put it in numbers, last year alone, China imported 250,000 of these cars, and while the tariff rate is 15%, it could go up to 25%, in line with the WTO rule. But here's the kicker: this isn't just about slapping higher taxes on foreign cars. This move aligns with China's broader strategy to promote green low carbon development. The Ministry of Commerce in China made it clear that it's about more than just trade. It's about transitioning the automotive industry to sustainability and away from gas guzzling vehicles. So what does this mean for NIO? Well, it's pretty clear that China is promoting new energy vehicles. Higher tariffs on large displacement fuel vehicles could steer more traffic towards a company like NIO, and of course giving a boost to other domestic players as well. As NIO investors, this could mean a strong market positioning in the near future, especially as the government continues to emphasize green energy. Now let's pivot to another game changer: solid-state batteries. Solid-state technology has been making headlines recently. Companies like Toyota and CATL announcing major breakthroughs. The batteries promise higher energy density, faster charging times, and greater safety compared to lithium-ion batteries. Imagine charging your car in less than 10 minutes and getting a range that could finally put an end to range anxiety. But what does that mean for range-extended electric vehicles like those produced by companies like Li Auto and BYD? Well, to be blunt, it could spell the end. Solid-state batteries might render EREVs obsolete as pure electric vehicles become more capable and without the need for a gasoline-powered backup. That's huge because it suggests a future where the industry shifts entirely to battery electric vehicles. Battery electric vehicles like those that NIO is producing solely. Speaking of battery electric vehicles, let's not forget about Tesla. The EV giant that has set benchmarks globally is now facing some quite interesting challenges. Recently, news broke that Tesla canceled its plans to build a factory in Southeast Asia. Initially, there were talks of Tesla setting up a new facility in Thailand, but those plans have since been scrapped. The team that was sent to execute the project has now been pulled back, and Tesla's now considering building local infrastructure like charging stations. This was confirmed by Malaysian officials, including the Prime Minister, who mentioned that Tesla's expansion in the region was not due to Malaysia's performance, but rather the fierce competition from Chinese electric vehicle manufacturers. The move raised an important question: is Tesla beginning to slow down on its global expansion efforts? For many automakers, Southeast Asia is seen as a land of opportunity, with vast growth and a strategic and potential gateway to other markets like the United States and the European markets as well. But Tesla's decision to pull back might indicate a shift in its strategy. In the past, Tesla's aggressive expansion driven by optimistic sales projections, led to rapid growth and the establishment of factories around the world. In 2022, Tesla set an ambitious goal aiming for 20 million annual vehicle sales by 2030. However, as we've seen, the market can be unpredictable. Despite reaching 1.8 million vehicle deliveries in 2023, Tesla's growth rates have been slowing, and by 2024, sales began to actually decline. With Chinese automakers making significant inroads in Southeast Asia like BYD, SAIC, and Great Wall, these companies are not only entering, but they're also dominating the market. Tesla finds itself facing tougher competition than ever. It's not just about sales though. Tesla's financial pressures have also been mounted. The revenue increased slightly in the second quarter of 2024, but net profits dropped by 45%, far below Wall Street's expectations. These challenges in mind, it's no secret why Tesla is reconsidering large investments like opening a new factory up in Thailand. By the way, this factory would have cost upwards of $5 billion. While Tesla might be pulling back in one area, it's charging full steam ahead in another area, and that is energy storage. In Shanghai, Tesla's construction of the energy storage super factory is pretty much moving at a breakneck speed. Just 3 months after breaking ground, the construction is already 45% complete. The facility is set to produce the Megapack energy storage system, which in my opinion is certainly a testament to Tesla's confidence in the Chinese market and global demand for their energy storage solutions. When completed, the factory will have the capacity to produce 10,000 Megapacks annually, providing an energy equivalent of 50,000 houses in Shanghai. So there's definitely some duality in Tesla's strategy here, pulling back on vehicle production while doubling down on energy storage. Could be seen as a smart move to diversify revenue streams and strengthen its competitive positioning within the market. But what does this mean for NIO as Tesla navigates these challenges? NIO's focus, particularly on battery electric vehicles, positions it well to continue to capture some of the market share that was once always all of Tesla's, especially in regions where Tesla might be slowing down. The competition's fierce, but NIO's ability to innovate and adapt will be the keys to its success, or their inability might be the keys to their failure, but it's all yet to be determined. It's all still to be seen. But I do think that there is opportunity amongst for NIO amongst all of these exciting developments. Anyways, thanks for tuning into today's episode of the Courtside Financial Podcast. Don't forget to like, subscribe, click the notification bell icon, leave a comment down below. We'll be back at you tomorrow with a new episode of the podcast, but I'm signing off. Thanks for watching.